Welcome back to the Options Academy. In this presentation, we'll discuss buying options spreads as a trading strategy. As always, to make the most of this learning experience, we recommend that you refer to our written article at www.theoptionsacademy.com, which matches this presentation. Buying options spreads. So many options buyers who buy outright calls and puts get stopped when it comes to buying options spreads. I've never understood spreads. I want to keep it simple, is what we often hear from fellow traders. It is our promise to you, therefore, that by the time you finish, you will have a better understanding of the basic concepts of spreads buying. So how do we create a debit spread? The mechanisms of a debit spread are very simple. To illustrate the point, let's use, for now, an imaginary underlying market, say, cotton candy. The summer is approaching, and you expect the cotton candy market to trend up with increasing demand via parks and carnival activities. Cotton candy is currently trading at the $90 level, and you're figuring it could climb up as high as $130 or $135 in the next 90 days. You decide to purchase the $120 call option in order to take advantage of your market view, planning for a goal of 10-point profit. However, a quick look at the 120 strike price reveals it is trading at a premium of $3,000, more than you want to risk on a single option. You decide to create a spread with a 10-point profit potential, less premium paid at inception in commissions. In order to do so, you simply buy the $120 call, paying $3,000, and continue to sell the $130 call, collecting $2,500. Buy a $120 call, pay $3,000, sell a $130 call, collect $2,500. Total cost, excluding commissions and fees, $500. And this is a real good time to remind you that in our written articles at theoptionsacademy.com, you can find illustrations that will help you get really clear on this point. So let's talk about buying the options closer to the market level. Philosophically speaking, every single trade you ever place has the theoretical potential to become a winning trade or a losing trade, regardless of any indicators, technical analysis, or fundamental events. Putting this thought aside, when you buy options, the closer to the market you buy, the better the potential is for a winning trade. When you buy an option 3% out of the money, the chances of the market reaching your strike price and higher may be greater than if you buy an option with a strike price 20% out of the money. As you can see from the example above, buying a spread reduces your cost basis significantly. By buying the 110 call and selling the $120 call, you are indeed limiting your profit potential to 10 points, less premiums paid and commissions. But now the market has to climb up only to the $120 level rather than to $130 level in order for you to make the most of the spread, and therefore increasing the probability for a winning trade. As an option buyer, you should always consider the potential profit and risk versus the probability that your option will expire worthless. Let's go over the potential profit profile. Similar to a naked call you would buy, once a long call spread is constructed, you are hoping the market will climb up. Although you sold a call option $130, you are looking for the market to trade up. In fact, for any long spread, a spread that you own, the maximum profit is manifested if at the time of expiration, the spread is fully in the money, the option you bought and the option you sold. Let's take a look and see how your spread will behave if the market follows your expectations and rises to $133 at expiration. The $120 call you own expires with an intrinsic value of $13. The $130 call expires with an intrinsic value of $3. Total value of the spread at expiration, 10 points. Let's take a look at how your spread will behave if the market follows your expectations but climbs to the $128 level only. The $120 call you own expires with an intrinsic value of $8. The $130 call you sold expires worthless, with no value at all. Total value of the spread at expiration, 8 points. You can clearly see that the best profit potential is when the spread is fully in the money at expiration. When a long spread you own expires fully in the money, you don't have to be concerned about being assigned a position in the underlying market. That is because both options are assigned, canceling each other. The call you own becomes a long underlying position, and the call you sold becomes a short underlying position. You do want to note, however, that letting your spread expire fully in the money and having both options assigned will result in 2 additional commissions, worth noticing and being aware of. Let's talk about limiting your potential profit. Let's see what happens if the market move exceeds your expectations and climbs even higher than you anticipated. Well, No matter how high the market goes, your potential profit on this specific spread is 10 points, less premiums paid in commissions. Let's take a look. Due to a rise in sugar prices coupled with an increased circus activities across the nation, demand was greater than expected and the cotton candy market climbed to $150. Here's how your spread looks. The $120 call you own expires with an intrinsic value of $30. The $130 call you own expires with an intrinsic value of $20. The total value of the spread at expiration, 10 points. No matter where the market closes above $130, the value of the spread at expiration will always result in 10 points. Creating a spread thus lowers your cost basis, sometimes significantly, but also limits your profits potentials. Let's see and understand how spreads gain or lose value. It is important to understand that spreads hold their value in a more consistent manner than naked options. If you buy a call and the market accelerates up, your call, depending how far it is from the market level, may gain a lot of value very quickly. If you buy a put and the market falls out of bed, your put is likely to gain value in the same fashion. Options spreads behave differently. Because a spread is a combination of a long option and a short option, the gain and loss of each as a result of any market move helps to keep the spread's value when the market trades away from it or towards it. The spread will reach near its full potential only if it is fully in the money and only if it is very near expiration. Take a look at any spread which is trading at the money or even fully in the money, but with 2 or 3 months to expiration, you will find that the spread is trading far below its full value. Now look at a similar spread, but with a few days to expiration. You will notice that the spread is trading at a much higher value than the former. If you are predicting a strong, short-lived move, a long-term spread might not be the right strategy to use. A short-term spread if the prediction is correct, and if you are willing to risk a higher premium. Let's talk about legging into a spread or buying it as a package. When dealing with any type of option strategy involving more than one option, the question always arises, should we place the order as one package, filled on all options or none at all? Or leg into the trade, get filled on each option separately? Both ways of action are available in most platforms, and if you are working with a broker and have direct floor access, they should be able to place very complex orders as one package, 4 even 6 option calls and puts, and in different months. We take the view that one is not necessarily better than the other, but it is important to understand the implications of legging into a trade. Legging into the trade means placing the order to buy and sell the options individually. This means that you first buy the long option and separately sell the short option, or vice versa. The advantage here that if you can play the market moves correctly, you can buy your long option cheap and sell your short option for a higher premium. For instance, if you are buying a call spread, you can attempt to buy the call option when the market moves down and the call you want to buy would therefore be cheaper. Then you can try and sell the short call, which is the second part of your call spread, when the market trends up and the call gains value. The risk here when you take this route is if you are filled on one option only and denied the other. For example, if you buy the call as the market trends down, but then the market keeps its downtrend rather than inch back up, you will end up losing on your long call option as a naked call, since you were never filled on the short side of your spread. Similarly, if you first sell your short option on a move up, but the market keeps heading upwards, you will not get filled on your long call and find yourself selling a naked option. In both these scenarios, you can sell or buy respectively the second option in the spread, but you are likely to get much worse pricing. Placing the order as a package is simple. You work the bid and ask on the 2 options as a package. You may get filled or denied, but you will not find yourself in a scenario in which you are long or short only one option, while the other side of the trade is not filled. Let's sum up what we've spoken about. Creating a debit spread is simple and done by simply selling an option with similar nature, call or put, in addition to the one you bought, farther out of the money. A spread lowers your cost basis and enables you to buy at strike prices that are closer to the money, thus increasing the likelihood of success. A spread does not gain or lose its value as fast as a naked option and holds its value better. A spread will never trade at its full value unless it is fully in the money and at expiration. Legging into a spread may offer better costs if you can time the entry point with precision, but exposes you to greater risks in the case of a runaway market. We hope this article helped you gain a better hold around the issue of spreads. If you have any questions at all, please call or email us. We will be glad to extend and expand any explanation you need. In the meantime, here's to your success. And remember, there is substantial risk of loss in trading future options. Remember that past performance is not necessarily indicative of future results. And remember that only risk capital should be used. Hope to see you again soon.